The Morgan Report with David Morgan. Discover how to build and protect your wealth at themorganreport.com.
David Morgan with this week's weekly perspective for the week ending 8 August 2025. I'm going to start at SilverGuru22, our Twitter feed or X, and just a few things to go over here. This is the most recent stuff. I post almost all this myself, and it's during the week as I see fit. Post this one from Bob Coleman talking about where we stand on the commitment of traders. Very interesting movement here recently, and he's indicating that we may be in a tight situation from that perspective, commitment of traders, and that we may have more upside. Another article here on platinum and how tight the market is according to this article. Another one here I'm going to scroll down to. This one's interesting as well. Discover how the gold to silver ratio serves as a key indicator for optimizing precious metals investments, timing, and allocation decisions. I think that one is well worth the read. Marin Katusa, well known in the newsletter world and the resource sector altogether. Good article he wrote on silver. And finally, I'm going to end with this one, and then more you can look at. New analysts reveal that the EU solar stalls, that 2025 projected to mark the first year of a market decline in a decade. So there is a bit of a controversy here. You can read this article. There are some saying that solar demand is going to increase year over year, including 2025 being greater than 2024. And there are the other side of the coin that is hesitant to make that statement. Regardless, the trend has been massively upward for solar PV installations, as we all know, and if it takes a breather here, it wouldn't surprise me. There's a lot more to report this week, especially about the proposed tariffs on gold and where it's refined and all that. It's kind of a hit and miss. I'm not going to delve into that. There's lots of articles that kind of go through what actually happened. So I thought I'd approach something that is somewhat controversial, and that is the difference between two well-known research groups in the precious metals and metals arena, particularly on the silver side, and that is the Silver Institute and CPM Group. So I asked the question, is the silver deficit real? And I start with the Silver Institute and source their data, which is Metals Focus, and they help compile the data for the Silver Institute. It might be pointed out that bigger doesn't always mean better, but I believe Metals Focus has somewhere over 30 people working in their facility, just to keep that in mind. And they have a definition. They look at the physical market balance. That's mine production plus recycling minus fabrication demand, which is industrial demand, which is about 6% of the market, jewelry, silverware, and physical investment demand. When demand exceeds supply, they call it a deficit. Key point. The deficit is physical metal, not paper contracts, and it assumes above ground inventories are drawn down to meet the gap. So supply and demand have to meet every year. And if your mining and recycling does not meet the demand, then you have to take something that already exists, above ground supply, to make it match. And according to the research for the recent years, the last 4 or 5, the Silver Institute, reported a physical deficit in the order of about 200 to 250 million ounces. That is the largest in decades. We had a deficit before, between 1990 and 2005, and that averaged about 100 million ounces a year. And by the way, that 15-year consecutive deficit really did not move the silver price very much. Just something to bear in mind. All right, let's move on to CPM Group. I'm sure Jeff will have something to say that I got it wrong, but to the best of my ability, it's from this CPM deficit definition. CPM says there is no structural deficit because when you include all silver flows, especially movements from extensive above ground inventories, private hoards, industrial supply, maybe warehouse government, which isn't very much, but there's some, purportedly ETFs and unreported stocks, the market balances. His view, silver demand never exceeds total available silver. If stocks are drawn down, it's not a deficit, it's simply disinvestment. CPN includes opaque sources like silverware melting, industrial scrap, not in official reporting statistics, and non-exchange inventories on the supply side. And I'm not going to rule all that out. I mean, there is some there. I would say it's secondary supply, meaning that most of it is not 99 fine silver. That would be silver, which what that word means, you should know by now if you follow me very closely, is COMEX grade bars or LBMA grade bars. So let's move on. Where the numbers clash or why they clash, accounting for the above ground stockpiles. Silver Institute treats the drawdowns from inventories as proof of a deficit. CPM treats those inventories as part of total supply. No deficit exists as long as stocks can be tapped. Okay, so who's right? And of course, I'm not going to try to take sides here. You can make up your own mind, and that's why I'm doing this video. Both are correct within their framework. So can they both be right? Well, perhaps. Silver Institute, right. If you define deficit as a current year plus mining, plus recycling, plus current year demand, this is the perspective that most investors see, and it makes for a more dramatic headline. CPM is right. If you define deficit only occurring when total demand exceeds total available supply, including above ground stocks. In this sense, there hasn't been a true shortage. Metal still comes from somewhere to fill the gap. The investor's takeaway. The Silver Institute's deficit signals that new mine output is insufficient to meet current demand, which is bullish for long-term prices. The CPM no deficit view signals that price spikes may be delayed until above ground inventories are exhausted. But once they are, the shortage becomes real and dramatic. In other words, Silver Institute is warning we're eating into the pantry every year. CPM is saying, yes, but the pantry's still stocked. And my add-on, the real inflection point is when the pantry shelves are bare, and that's when the market goes parabolic. So I'll leave it there. I think it was fair. I know both Jeff Christian and Mike Lorenzo of the Silver Institute. I've known them both for years. I get along with them both on a professional basis. And that is hopefully useful for your thinking. Who's right? You can make up your own mind. I'm going to leave it there. This is David Morgan with this week's Weekly.
The U.S. government debt is about to cross $37 trillion. That's not a typo. That's trillion with a T. Tariffs are being used to try and even the playing fields. Global supply chains are shifting. Inflation isn't going away. And the value of your dollar? It's quietly being drained while no one is really talking about this. The truth is, we're living through the early stages of a financial reset, whether anyone wants to admit it or not. And if you're still relying on mainstream headlines or financial advisors who just tell you to write it out, you could be blindsided when things really shift. That's where the Morgan Report comes in. For over 25 years, David Morgan has been helping investors cut through the noise. He tracks what actually drives markets, from precious metals and mining stocks to global debt and monetary policy, and show you how to protect and grow your wealth when the system is under stress. This isn't just about gold and silver. It's about having a clear-eyed view of where things are headed and making sure you're not caught off guard. The Morgan Report gives you real research, honest analysis, and strategies you can act on, even in a world of rising debt, unstable currencies, and economic uncertainty. Go to themorganreport.com today, download your free report, get informed, get ahead, and take back control of your financial future. Themorganreport.com, because $37 trillion in debt won't